AI bubble versus tech supercycle. Lessons from the dot-com crash. Artificial intelligence is absolutely everywhere. From local coffee shops to the boardrooms of trillion-dollar conglomerates, people whisper of the greatest revolution in human history. But wait, do you smell the burning fuse of a ticking time bomb? Are we truly entering a glorious new tech supercycle, or are we simply repeating one of the most classic financial tragedies in history, known as the dot-com bubble? To understand the future, we must journey back to the late 1990s. This was the dawn of the internet, planting dreams of a borderless world into investors' minds. People believed traditional business models would be utterly wiped out overnight. That frantic fever transformed completely unknown startups into multi-billion-dollar giants within a single day. Just look at the Nasdaq chart from that era. It was not a normal growth curve, but a sheer vertical wall defying every law of physics and economics. Investors back then threw fortunes at any company with a dot-com suffix, completely ignoring the fact that they had zero revenue, let alone profit. Unprecedented euphoria completely blinded society. From housewives and taxi drivers to college professors, everyone talked of tech stocks. People truly believed a new era had arrived and old rules were dead. Making money had never been easier, and the fear of missing out pushed this insanity to its absolute peak. Remember Pets.com, an online pet supply store. They burned cash on massive marketing campaigns, buying Super Bowl ads featuring a simple sock puppet. Their valuation soared to hundreds of millions, even though they lost money on every single order due to high shipping costs. But who cared? Back then, user growth was the only metric that mattered. And then, the needle struck. In less than 268 days from its initial public offering, Pets.com filed for bankruptcy. The dot-com bubble burst violently, wiping out $5 trillion in investor wealth. Thousands of tech startups vanished without a trace, leaving behind empty offices and shattered dreams. Now, back to the present, do you see the terrifying similarities? Today, we have generative AI, we have ChatGPT, Midjourney, and thousands of new AI applications emerging weekly. Companies large and small compete to announce AI integration just to satisfy Wall Street shareholders. In the dot-com craze, simply adding single quotes.com to a company's name doubled its stock price. Today, merely adding single quotes.ai or announcing a vague AI research plan can boost a company's valuation by billions. Human nature never changes, only the technologies and terms were new disguises to trap greedy capital. Venture capital funds are pouring hundreds of billions into AI startups with zero regard for actual business models. They live in absolute terror of missing the next Google or Microsoft. But the ultimate question is this mountain of cash creating real economic value, or just feeding empty sci-fi promises? We must view this situation with absolute objectivity. Not everything that glitters is a bubble, and not every technology revolution is a scam. The truth lies on the thin line between overhyped expectations and actual practical capability. Let us dive deeper to see if history is repeating, or if we are entering a truly different era, entering the next stage of our journey, analyzing the reality. Financial bubbles do not appear out of nowhere. They always follow a very clear pattern of crowd psychology. The initial cycle of euphoria is always triggered by a genuinely valuable technological advancement, not thin air. The internet was real, and AI is absolutely real too. Let's compare today's Nvidia to Cisco systems in the year 2000. Cisco back then was the greatest shovels-and-pick seller of the dot-com era, providing the routers and hardware to build the internet's infrastructure. Today, Nvidia is identical, holding a near monopoly on high-end GPUs required to train large language models. At its peak in 2000, Cisco was valued at over 100 times forward earnings. When telecom startups ran out of money and stopped buying network hardware, Cisco's revenue collapsed, and its stock plummeted nearly 90%, never to recover its peak. Can Nvidia avoid this fate when their major cloud customers begin optimizing their existing hardware? The current demand for AI chips is utterly frantic. Tech titans like Microsoft, Meta, and Google happily burn tens of billions to hoard every single H100 chip Nvidia can produce. Whoever possesses the most chips is deemed the victor in this digital arms race. But every arms race eventually reaches a saturation point. The single greatest difference between Nvidia today is Cisco. The past is actual, hard profit. Nvidia is not just selling empty promises. They are pulling in tens of billions of dollars in net income each quarter with a gross margin of over 75%. This is an unprecedented money printing press in semiconductor history, making many believe this is no bubble. However, Nvidia's monopoly cannot last forever. Competitors like AMD are aggressively catching up, while their own largest customers like Google, Amazon, and Meta design custom chips to escape dependency. Once supply catches up and demand cools down, those insane profit margins will inevitably shrink dramatically. To understand deeper, let's divide the AI value chain into two layers: infrastructure and application. Right now, capital is pouring almost exclusively into infrastructure chips, data centers, and electricity. Meanwhile, the application layer, the actual software creating end-user value, is struggling to find sustainable business models. Are you willing to pay $20 a month for ChatGPT, another $20 for Midjourney, and another $20 for various other productivity tools indefinitely? For the vast majority of consumers and small businesses, this cost is far too high compared to the actual utility delivered. The application market is already showing early signs of saturation. Most AI tools today are merely interesting rather than mission-critical. They can write a mediocre poem, generate a cute picture, or summarize a long document. But are these features enough to save struggling enterprises? When VC subsidies run completely dry, these superficial apps will vanish into thin air. Another massive bottleneck that the dot-com era never had to face is energy and resources. Running massive language models consumes a monumental amount of electricity, enough to power entire small cities. AI data centers are pushing global power grids to their absolute breaking point, sending operating costs into orbit. Now, let us embark on part 3, diving deep into the core economics of AI to see how it differs from the dot-com crash. Back then, the cost of building websites and purchasing servers was the main hurdle. Today, building and maintaining a frontier AI model demands billions in continuous investment, keeping this game strictly for tech titans. The business model of generative AI is extremely strange. The marginal cost of serving an additional customer is not zero like traditional software. Every single query you type costs real electricity and silicon. Therefore, soaring user counts don't automatically mean profit. In fact, more users can mean deeper losses if the hardware is not optimized. This is the core issue. Valuations of AI companies are based on the bold assumption that they will solve this cost problem in the future through scale. But if Moore's law slows down and semiconductor costs don't drop fast enough, these startups will bleed dry before reaching break-even. It is an extremely risky gamble. Just look at what happened to the early pioneers of the dot-com era. Yahoo was once valued at over $120 billion, only to be sold later for a measly $4.8 billion. This wasn't because the internet failed, but because Yahoo overvalued its early earnings potential during the infancy of the World Wide Web. OpenAI, the giant behind ChatGPT, is valued at hundreds of billions of dollars in private funding rounds. Yet, reports suggest they bleed billions annually to cover server costs and pay top-tier engineers million-dollar salaries. Is this model remotely sustainable without continuous cash injections from Microsoft? Beyond costs, AI faces a colossal legal fortress. High-profile copyright lawsuits from writers, artists, and publications like the New York Times threaten the core data pipelines of AI training. If they can no longer scrape the web for free, the cost to train AI will soar exponentially. To avoid losing your shirt, you must clearly distinguish between short-term hype and long-term utility. Roy Mara, a renowned scientist, famously said, "We tend to overestimate the effect of a technology in the short run and underestimate the effect in the long run. This is Amara's law." Remember that after the dot-com crash, the internet didn't vanish. Instead, the crash purged the speculative garbage and lowered the cost of fiber optic networks. From those ashes, true titans like Amazon, Google, and Apple finally had the space to grow sustainably and eventually dominate the global economy. An identical scenario could unfold with artificial intelligence. We will likely experience a brutal valuation correction, where 90% of current AI startups will completely go bankrupt. But the surviving 10% of those companies will be the ones that shape the global economy for the next several decades. The core difference is that AI is already providing immediate, measurable productivity boosts. Software engineers write code twice as fast using AI assistants, and customer service departments are being automated with massive efficiency gains. These are not empty promises, but real economic gains occurring daily. But the most critical question remains: how do we ordinary, retail investors survive and build wealth inside this storm? Should we completely shun AI, or bravely dive into the wave with wisdom? The answer lies in practical, hard-headed investing, completely detached from the emotions of the screaming crowd. First piece of advice: never buy stocks that rally solely on generic AI announcements. If a company lacks an actual, commercialized AI product, yet management mentions the buzzword dozens of times during earnings calls, that is a massive red flag waving directly at your wallet. During the 19th century gold rush, the vast majority of gold miners went home empty-handed or broke. The only entities that consistently generated immense wealth were those selling picks, shovels, Levi's jeans, and tents. Apply this exact mindset to find companies providing indispensable infrastructure to the AI ecosystem. These could be utility companies operating electricity grids, nuclear power plants providing green energy to data centers, or cooling systems manufacturers for supercomputers. They do not need to build successful AI models. They simply sell the vital resources every single AI cluster must consume to survive. Take close attention to the economic moat, the sustainable competitive advantage of a business. An AI startup whose software can be easily cloned by competitors within weeks is a terrible investment. Instead, look for companies that own exclusive proprietary datasets which no competitor can simply scrape or buy. For instance, healthcare networks holding millions of historical medical records to train diagnostic AI, or financial firms with decades of transaction data. Proprietary data is the new crude oil of the digital age, and whoever owns the largest oil fields will stand victorious once the speculative smoke clears. The next strategy is smart diversification. Never put all your eggs into a single speculative AI basket. Maintain a solid portion of defensive assets, cash, gold, or traditional defensive value stocks with consistent dividend streams to shelter yourself when market turbulence inevitably strikes. Patience is your ultimate weapon. The pop of any bubble is always accompanied by extreme market panic, dragging the prices of high-quality companies down to absurdly cheap valuations. That will be your once-in-a-lifetime window to accumulate shares of great businesses at fire sale prices. Be patient and wait for that moment. Financial history clearly demonstrates that those armed with preparation and steel discipline always win in the end. Bubbles may burst, speculative paper wealth may evaporate, but economic wisdom and rational investing principles will always remain to help you rebuild lasting, true prosperity. We have zero reason to fear the future. The rise of artificial intelligence is an inevitable step in human advancement. By understanding the rules of the game and avoiding herd mentality traps, you can confidently walk your own stable financial path, no matter how chaotic the outside world becomes. Now, we enter the final act, the actionable blueprint. Do not just sit here watching this video and worrying. Transform this hard-won knowledge into practical steps to shield your money today. Step 1 is vital. Audit your current portfolio to weed out toxic, highly speculative elements. Be brave enough to prune tech stocks with opaque business models or AI startups bleeding venture capital. Cutting your losses early preserves precious capital, leaving you ready to seize high-quality, practical opportunities at deeply discounted prices when the market inevitably corrects itself. Step 2. Build up your cash reserves and highly liquid assets. Cash is not trash during periods of extreme market volatility. It is the absolute king. It acts as your ultimate weapon to scoop up premium assets at deep discounts when the bubble bursts. Never allow yourself to be cash poor when the opportunity of a lifetime arrives. Step 3. Invest in yourself before investing in financial markets. Become someone who actively integrates AI tools into your daily workflow rather than a speculator in AI stocks. Mastering these tools to double your individual productivity is an investment that yields infinite returns, immune to market crashes. Step 4. Construct a robust information filter. Turn off sensationalist financial clickbait and speculative chatrooms. Focus instead on audited financial statements and deep fundamental analysis from reputable sources. Your mind can only remain clear if you feed it clean, high-quality data. Always remember that in the world of investing, the longest survivor is the ultimate winner. Never let short-term greed wash away years of hard work and savings. Anchor yourself firmly to fundamental valuation principles and never allow volatile market tides to drag you into hazardous rocky reefs. I trust you now hold a far more comprehensive and structured view of this AI race by examining the scars of the dot-com crash. History does not repeat itself step for step, but it always rhymes with fascinating rhythm. Be the wise investor who masterfully steers the financial ship of your own life. The next golden era belongs entirely to those with the patience to accumulate deep knowledge and wait for the perfect moment. The storm of the AI bubble may erase countless speculative illusions, but it will simultaneously open immense doors of wealth for the cold-headed realists who keep their sanity intact. If you found this deep financial breakdown valuable for your personal wealth journey, please hit that subscribe button and ring the notification bell. Your fantastic support is the lifeblood and greatest fuel for me to continue crafting these higher attention, institutional-grade finance stories for you. Thank you so much for your incredible company throughout these 50 scenes of rigorous financial investigation. Always keep a cool, rational head and a steadfast heart in the face of raging market tides. Goodbye for now, and I will see you in our next deep dive financial story.